Global liquidity is drying up as the $500 billion reverse repo cushion vanishes, threatening a market meltdown before most investors even realize the tap has been turned off.
Former Fed insider Joseph Wang, known as the Fed guy, warns that the plumbing of our financial system is clogging, and he is joined by experts like Gerli, Jeff Snider, and Michael Pento to reveal the cracks.
We have used advanced AI to distill hours of high-level macro analysis from these industry leaders into the critical minutes you need to stay ahead and protect your wealth.
You will discover why over 800,000 ghost jobs are masking a labor crisis, and which technical levels could trigger a 30% stock market crater.
Today, we are breaking down the latest macro update from Joseph Wang, often called the Fed guy, for his time at the open market desk.
Joseph brings that rare inside baseball perspective on how the Fed actually moves trillions of dollars through the system.
Wait, so he actually pushed the buttons to move the money? Like for the actual Fed?
Exactly. He was in the room where the plumbing of the global financial system gets managed.
And his latest take on market liquidity is a massive warning sign for anyone holding stocks right now. Joseph Wang's core thesis is that the $500 billion cushion in the reverse repo facility is the only thing keeping markets stable.
Right, and as that facility hits zero, we lose the buffer that prevents interest rate spikes in the private market.
Hold on. Reverse repo. Is that like a bank's emergency savings account or something?
Think of it as a massive bucket of idle cash. Once the bucket is empty, the Fed has to find a new way to keep the engine oiled.
While that liquidity drain is the immediate threat, Joseph also points to a massive treasury supply shock coming in the second half of the year.
So we're losing the cash buffer, just as the government is asking for more money. That sounds like a disaster.
According to Joseph Wang, the Treasury is set to dump $1.6 trillion in new debt onto the market this year.
And with the Fed doing quantitative tightening, there's no big buyer left to scoop up all those bonds.
1.6 trillion. Who is actually going to buy all that if the Fed isn't?
That is the trillion-dollar question. If buyers don't show up, yields have to go higher to attract them.
Which means borrowing costs for everyone, from credit cards to mortgages, are headed for a painful reset.
So my mortgage rate is basically tied to how many bonds the government can sell.
Joseph points out that the Fed is still shrinking its balance sheet by $95 billion every single month.
It's the opposite of the money printing we saw in 2020. They are literally pulling cash out of the system.
Wait, so 95 billion is just vanishing every month?
Pretty much. It's like the Fed is vacuuming the floor while the Treasury is trying to throw a party.
Joseph argues this vacuuming will continue until something in the banking system actually breaks.
I don't like the sound of breaking. Can we just not do that?
One indicator Joseph watches closely is the SOFR rate, the secured overnight financing rate.
If that rate starts spiking, it means banks are desperately scrambling for cash behind the scenes.
Is that like the check engine light for the whole economy?
Exactly. When the check engine light flashes, it doesn't matter how fast the car is going, you're in trouble.
Joseph's data shows we are seeing more of these flashes lately, suggesting the plumbing is getting clogged.
Great. So the car is smoking, and the Fed is still vacuuming the back seat.
Joseph Wang predicts the Fed will be forced to end quantitative tightening by the fourth quarter of 2026.
He thinks they'll have to stop early because the repo market will simply run out of air.
So if they stop, does that mean the stock market goes back up?
In the short term, maybe. But Joseph warns that the stop usually happens only after something major breaks.
So it's not a we fixed it stop, it's a the building is on fire stop.
I'm starting to think the Fed guy has some pretty scary bedtime stories.
Joseph also sees a scenario where the 10-year Treasury yield spikes to 5.5%.
That would be a massive headwind for tech stocks and anything sensitive to interest rates.
5.5%? That's higher than it's been in what, decades?
Since before the Great Financial Crisis. It changes the math for every investor on the planet.
If Joseph is right, the easy money era isn't just over, it's being buried.
Note to self. Maybe don't look at my brokerage account for a while.
Joseph's top advice? Keep an eye on the SOFR to OIS spread.
It's the most technical indicator, but if it widens, that's your signal to head for the exits.
Wait, SOFR to OIS. Can I get that on a normal app, or do I need a Fed terminal?
You can track it on most financial sites. If it stays flat, you're safe. If it jumps, move to cash.
He also suggests moving towards short-duration Treasury bills rather than long-term bonds.
Exactly. Stay flexible and keep your cash where it's not locked in while rates are swinging.
So, keep my money on a short leash until the Fed stops vacuuming?
That's exactly Joseph Wang's playbook for the rest of the year.
In this market, liquidity is king, and according to Joseph, the king is currently on a diet.
Got it. Cash is king and the vacuum is loud. Thanks, Joseph.
Today, we're dissecting a massive warning from Gerli of Reventure Consulting regarding the sudden surge in job cuts across the country.
Nick's analysis shows that while the headline numbers look stable, the underlying trend of layoffs is spreading way faster than the mainstream media is reporting.
Wait, if layoffs are spreading, why does everyone keep saying the job market is strong?
That's exactly what Nick is challenging. He's looking at the data that shows companies are quietly thinning the herd before a bigger storm hits.
Nick points out this isn't just a Silicon Valley problem anymore. It's hitting retail, finance, and even manufacturing.
Exactly. We're talking about a broader economic shift that could trigger a significant pullback in consumer spending.
So basically, the help wanted signs are coming down and the pink slips are going out.
According to Nick Gerli, that's precisely the shift we're seeing right now. The core of Nick Gerli's thesis is that corporate layoffs have jumped 15% in just the last quarter alone.
And the scary part is that this is usually a leading indicator for a recession. Once that momentum builds, it's hard to stop.
Hold on, 15%? That sounds like a lot of people losing their paychecks all at once.
It is, and Nick argues that this is the alpha insight. The job market is cooling much faster than the Fed's target.
Which means, while people are worried about inflation, the real threat might be the disappearing paycheck.
So we're trading high prices for no jobs. That's a terrible trade.
Nick highlights that small businesses aren't just firing people. They're cutting hours by 10 to 12% first.
Right. It's a quiet layoff. People still have jobs, but they're taking home way less money.
Wait, so the unemployment rate stays low even if everyone is making less? That's sneaky.
Exactly. Nick calls this the hidden weakness in the labor market. It's a precursor to actual job losses.
When you see hours cut like that, it's because the revenue isn't there to support a full-time staff.
So my favorite coffee shop might still be open, but the staff is struggling to pay rent.
Nick notes that over 200,000 tech jobs have been slashed, and it's starting to bleed into other professional services.
Think about all the marketing agencies, law firms, and recruiters that serve the tech industry. They're next.
200,000. That's like a whole city of software engineers looking for work.
And because these are high-paying roles, that's a massive amount of capital being pulled out of the housing and luxury markets.
Nick's data shows that this ripple effect is exactly how a localized slowdown becomes a national recession.
So if the tech bros stop spending, we all feel it.
Based on current trends, Nick Gerli predicts unemployment will hit 4.5% by the end of the fourth quarter.
That doesn't sound high, but historically, once unemployment rises by 0.5% from its low, a recession is almost guaranteed.
So 4.5 is the magic number where things go south.
According to the Sahm Rule, which Nick often cites, yes. We're dangerously close to that threshold.
It's the momentum that matters more than the actual number.
Great. Another magic rule that ends in me spending less on pizza.
Nick also predicts that job losses will lead to forced selling, potentially increasing housing inventory by 20%.
If you lose your job and can't find a new one in 3 months, that house goes on the market.
Wait, so more houses for sale is good for buyers, right?
In theory, but only if you still have a job and can get a mortgage.
Exactly. Nick's point is that the supply increase won't be from happy sellers, but from people in financial distress.
Oh, so it's a fire sale. That's way less fun.
Nick's top advice? Start monitoring warn notices in your state to see which companies are planning mass layoffs.
It's public data. If you see a major employer in your town filing a warn notice, that's your cue to tighten the belt.
What's a warn notice? Is that like a warning sign?
Basically, it's a law that requires companies to give 60 days notice for large-scale job cuts.
It's the ultimate early warning system for your local economy.
Finally, Nick emphasizes building a 6-month cash reserve immediately.
With the labor market cooling this fast, liquidity is your best friend. Cash is king when jobs are scarce.
6 months of cash? I've got like 6 days of cash and a half-eaten burrito.
Then Nick's analysis suggests it's time to start saving, and fast.
Better to have it and not need it than to be part of that 4.5% unemployment stat.
Okay. Saving starts now. Burrito is the last luxury.
Matt deWolf from Trade Brigade is looking at this overnight rally and asking the big question. Is this just another fade in the making?
Exactly. Matt points out that while peace talk headlines are sparking green on the screens, the technical structure doesn't necessarily support a long-term bottom yet.
Wait, a fade? Is that just trader speak for a rally that's about to fall on its face?
Pretty much. It's when the market gaps up on news, but the sellers are waiting at the top to push it right back down. Yeah.
The alpha here is the 4,400 level on the S&P 500. Matt says if we don't hold that, the whole rally is a trap.
Right, but he also teases a massive divergence in the Nasdaq that could ruin the party for tech bulls later today.
So we're looking at a 4,400 line in the sand. That's a huge psychological number.
It is, and Matt's data suggests the volume behind this overnight move is thinner than it looks. According to Matt deWolf's analysis, the market is gapping up about 1.5% on news of more peace talks.
But Matt warns that headline risk works both ways. If the talks stall, that 1.5% gain evaporates in seconds.
So the market is basically reacting to tweets and news alerts right now? That feels incredibly risky.
It's pure sentiment. Matt's thesis is that the price action needs to prove itself at previous resistance levels before we can trust this move.
Matt deWolf is laser focused on the ES levels. He sees resistance sitting right at 44.20.
And the downside is just as tight. If we slip under 43.80, Matt thinks we're heading back to the weekly lows.
Hold on, 44.20 to 43.80. That's only a 40-point range. Isn't that super narrow for this volatility?
It's tight, which means the breakout will be explosive when it happens.
Exactly. Matt is looking for a clear gap and go or a gap and crap scenario at the open. Matt also mentions a clear divergence. The Nasdaq isn't keeping up with the S&P 500.
That's usually a bad sign for the broader market. Tech needs to lead for a rally to be sustainable.
Wait, so if Apple and Microsoft aren't pumping, the whole market is basically on stilts.
Precisely. Matt's chart shows the NQ failing to break its overnight high, while the ES is hovering near it.
It's like the engine is sputtering while the car is still trying to go uphill. Despite the green morning, Matt deWolf notes the VIX is still sitting above 30.
That's high. Usually, a real recovery sees the VIX crush lower, but it's being stubborn right now.
30 on the VIX? Doesn't that mean investors are still terrified?
It means they're paying a lot for insurance. Matt thinks this indicates that nobody is truly all in on this rally yet.
Right, high VIX plus a headline rally usually equals a volatile reversal.
Matt deWolf's bullish prediction is a close above 44.20. If that happens, he sees a clear path to 4,500.
That would be an 80-point run from the resistance level, which is massive for a single leg.
So if we end the day above that line, we're basically in the clear for a few days.
It would confirm the peace talk rally has some actual legs, rather than just being a news pop.
On the flip side, Matt warns that failing at 43.80 opens the door to a retest of the 4,200 lows.
That's a nasty drop. We're talking about a multi-100-point slide if the support fails.
Wait, 4,200, that's way down there. Why would it fall that far?
Because there's no major support between here and there. It's a valuation air pocket, as Matt's charts suggest.
If the peace news turns out to be fake, the selling will be twice as fast as the buying was.
Matt's biggest takeaway? Watch the first 30 minutes of trading. Let the amateur hour pass before picking a side.
He recommends the opening range breakout strategy. If the price stays above the 30-minute high, go long. If it breaks the low, short it.
So I just wait 30 minutes and follow the leader. That sounds surprisingly simple.
It's about discipline. Matt says the most money is lost by traders jumping in at the opening bell before the trend is set. Finally, Matt deWolf suggests keeping an eye on the dollar and treasury yields.
If the dollar keeps climbing, it's going to act as a headwind for this rally, no matter what the peace headlines say.
So if the dollar goes up, stocks usually go down. Why is that?
It makes exports more expensive and tightens global liquidity. Matt uses it as a sanity check for any rally.
It's all about the macro backdrop to keep things in perspective and stay disciplined with the plan. Look, the headline jobs numbers look okay, but Jeff Snider is sounding a massive alarm that the labor market is actually cracking under the surface.
Jeff's analysis shows that we're moving past a simple cooling phase and straight into a cyclical downturn that historically ends in recession.
Wait, cracking? I thought everyone was still hiring and the economy was resilient or whatever.
That's the trap. Jeff says the labor market is the ultimate lagging indicator. It's the last thing to break, and it's starting to go now.
Exactly, and while we'll get into the fake jobs data in a second, the big takeaway is that the soft landing narrative is officially on life support.
Jeff Snider points to the massive benchmark revision, suggesting 818,000 jobs reported last year didn't even exist.
It's the largest downward revision since 2009. The government's models were basically hallucinating growth.
Hold on, 800,000? That's not a rounding error. That's like a whole city of people who aren't actually working.
Exactly. The birth-death model the BLS uses assumes new businesses are opening left and right. But Jeff argues that's just not happening in this credit environment.
The reality is, if you remove those ghost jobs, the labor market looks much more like a recessionary environment than a booming one.
So we've been making policy decisions based on imaginary employees. That's terrifying.
Jeff highlights a scary trend. We've actually lost over 1 million full-time jobs in the last 12 months. Well,
the only reason the total employment number hasn't crashed is because people are picking up part-time gigs to survive.
Wait, so the jobs growth is just people working 2 part-time jobs because they lost their career-level position?
Spot on. Jeff Snider calls this the deterioration of labor quality. It's a classic sign of an economy losing its engine.
And when companies start cutting full-time roles, it's because they're bracing for a major drop in demand.
So the headline number is basically a lie if you don't look at the hours worked.
Jeff notes a massive divergence between the establishment survey, what companies say, and the household survey, what people actually report.
The household survey is much weaker. It shows unemployment rising much faster than the official payroll data suggests.
Which one is usually right? Please tell me. It's the one that says things are fine.
Actually, Jeff argues the household survey usually catches the turning points in the economy first.
Right? It's the boots on the ground view. If people say they aren't working, regardless of what a spreadsheet says.
So the official data is basically the last person to find out the party is over.
Jeff points out that the move in unemployment from 3.4 to 4.3% has triggered historical recession rules.
Once unemployment starts rising by 0.5% or more off the lows, it almost never stops until it's much higher.
Is that the Sahm Rule? I've heard that's like the black swan of job stats.
Exactly. Jeff explains that this momentum is nearly impossible to stop because it becomes a self-reinforcing cycle of less spending and more layoffs.
It's a snowball effect. Once it starts rolling down the hill, interest rate cuts usually can't catch it in time.
So we're already past the point of no return.
Jeff Snider predicts we're going to see even more massive downward revisions to the current jobs data as the year progresses.
The lag in data collection means we're currently looking at the economy through a rearview mirror that's been smudged.
Wait, so it could actually be worse right now than we even think.
That's Jeff's core thesis. By the time the official numbers look recessionary, we'll already be 6 months into the crash.
It's like realizing you have a flat tire while you're already doing 80 on the highway.
I really need to stop listening to these everything is fine headlines.
Jeff believes the Fed is going to have to pivot to panic rate cuts once the labor market cliff becomes undeniable.
But, as Snider often says, the eurodollar market is already pricing this in. The bond market knows the Fed is behind the curve.
Panic cuts sounds bad. Isn't that what they did in 2008?
Exactly. Panic cuts usually happen when the damage is already done. They're trying to put out a forest fire with a garden hose.
Jeff warns that lower rates won't fix a broken labor market overnight. It takes years to heal those scars.
So lower rates isn't the magic wand everyone thinks it is.
Jeff Snider suggests watching the yield curve uninversion very closely. It's the ultimate warning shot.
When the curve uninverts, it means the market is screaming that a recession is here, not just coming.
Wait, I thought inversion was the bad thing? Now uninversion is bad too?
The inversion is the warning, the uninversion is the impact. Jeff's data shows this is when the stock market usually gets hit hardest.
He also recommends monitoring credit spreads. If they start widening, liquidity is drying up.
In a labor market crash, cash flow becomes king. Jeff's analysis suggests being very cautious with high-risk corporate debt.
So basically, keep it simple and keep an eye on the exit door.
That's the Jeff Snider playbook for a labor market warning. Don't wait for the headline to tell you what the data already has.
Couldn't have said it better. The warning is in the numbers. You just have to look at the right ones.
Guess I'm checking the yield curve before I buy anything else.
We're breaking down a major warning from Chris Vermeulen of the Technical Traders. He's signaling a massive stock market correction of 20 to 30%.
Chris isn't just guessing. His technical charts show the S&P 500 hitting an exhaustion point that usually precedes a major washout.
Wait, 30%? That's not a correction, that's a crater. Are we talking about a total collapse here?
It's a technical reset. Chris notes that while stocks might dive, this actually clears the stage for gold and silver to go parabolic.
So while the S&P 500 is sweating, Chris says precious metals are the place to be. But haven't we heard the gold is a safe haven story before?
True, but Chris points to a specific cup and handle pattern on the charts that hasn't looked this bullish in decades.
Hold on, a cup and handle. Is that a technical term, or are we just describing my kitchen cabinet now?
Haha, it's a chart pattern. It means price is consolidating before a massive breakout. Chris thinks it's about to trigger a huge move.
And while gold looks like a hero, Chris has a much darker outlook for oil, which we'll get into in just a minute. Chris Vermeulen's core thesis is that the broad market is in a stage 3 topping phase. Basically, the momentum is dying.
Exactly. He observes that big money is quietly rotating out of tech and into defensive sectors, even if the headlines look shiny.
So the stage 3 thing, is that like the final boss level before the market loses its last life?
Pretty much. It's the distribution phase where the pros sell to the late comers right before the stage 4 decline.
Chris is watching the US dollar index, specifically the 104 level. Why is that specific number so important?
Because if the dollar breaks above 104, it puts immense pressure on commodities like oil and copper.
Wait, so a strong dollar is actually bad for my gas prices or my investments?
For your investments in oil, yes. Chris notes that a rising dollar usually makes commodities more expensive for the rest of the world, which kills demand.
So it's a tug of war. If the dollar wins, commodities lose, and Chris's charts show the dollar isn't finished yet.
Speaking of oil, Chris highlights that West Texas Intermediate is struggling to stay above $70 a barrel.
He's seeing a series of lower highs. That's a classic bearish signal, isn't it?
Lower highs? That sounds like my motivation on a Monday morning. Is oil basically giving up?
Essentially, Chris believes that without a major geopolitical shock, the technical path for oil is headed towards $65 or lower.
So while gold is the star, oil is definitely the villain in Chris's current script. Let's look at silver. Chris says the $30 mark is the line in the sand for a massive rally.
He's tracking the SLV ETF and notes that once 30 is cleared, there's very little resistance up to 35 or even 40.
30 to 40. That's over a 30% jump. Is silver really that explosive?
Chris calls it the high beta version of gold. When gold moves, silver usually runs twice as fast.
So if you're looking for the big move Chris mentioned in his title, silver might be the fastest horse in the race. Chris Vermeulen is predicting gold will hit $2,700 before the year is out.
He bases this on the Fibonacci extension levels from the recent breakout. The math points directly to that 2,700 target.
Fibonacci? Now we're doing Italian math? Can we just say gold is going to be really expensive?
Haha, basically. But Chris uses these sequences to find where the next ceiling is. It's about precision, not just guessing.
What about the miners? Chris thinks the GDX could see 40% upside if gold stays above its support.
Exactly. Miners have been lagging, but Chris notes they are finally starting to show leverage to the gold price.
Leverage? Does that mean if gold goes up a little, the miners go up a lot?
Precisely. If gold moves 5%, Chris expects mining stocks to move 10 or 15%. It's a high-risk, high-reward play.
But Chris warns that if the broad market crashes, even miners might get dragged down temporarily in the initial panic. Chris suggests investors watch the 20-day moving average on the S&P 500 as the first warning sign.
If it breaks and stays below that line, Chris says that's your signal that the stage 4 decline has officially begun.
So if that line breaks, I should probably stop checking my 401k for a while. Right?
Or you look for opportunities in the assets Chris is bullish on, like precious metals.
Ultimately, Chris's message is about capital preservation. Don't get greedy when the charts are screaming caution.
Right? He emphasizes that being in cash or defensive assets is a valid strategy when volatility spikes.
So basically, don't be a hero until the dust settles.
Exactly. Wait for the technical setup Chris described to confirm the bottom before jumping back in.
We are breaking down Michael Pento's latest warning to Adam Taggart. We're staring down the barrel of Great Recession 2.0.
Michael's alpha is clear. The $100 trillion credit market is the real bubble, and it is finally starting to pop.
Wait, 100 trillion? That's more money than I can even wrap my head around. Is my savings account safe?
It's the entire global debt system, and Michael believes it's reaching a breaking point because of high interest rates.
And while the credit market looks shaky, Michael says there is a specific asset that will fall 50%, which we'll cover in a bit. Michael Pento's core thesis revolves around that $100 trillion credit market he discussed with Adam Taggart.
Precisely. He argues that after 40 years of falling interest rates, the everything bubble has nowhere left to go but down.
So wait, if the bubble is everything, does that mean my house, my stocks, and my 4th grade baseball card collection are all going down?
Basically, when the cost of borrowing stays high, the value of everything bought with debt has to fall.
It's simple math with very ugly consequences for the average investor. Michael points out that the Fed's hikes don't hit the economy instantly. There is a 12 to 18-month lag.
Exactly. We are only just now feeling the pain from the rates set a year ago, and there is much more coming.
Hold on. So you're saying the economic medicine takes a year to even start working? That's a slow doctor.
It's more like a slow poison if you're a borrower. By the time the Fed realizes they've broken something, it's usually too late.
Michael told Adam Taggart that commercial real estate is the next shoe to drop, with $1.5 trillion in debt needing to be refinanced soon.
1.5 trillion. Is that why I see so many for lease signs in the city lately?
That's part of it. These buildings were financed at 3%, and now they have to renew at 7 or 8%.
Most of those owners can't afford that jump. It's a massive default risk waiting to happen.
Michael also highlights that banks are slamming the brakes on lending, reaching levels we haven't seen since the 2008 crash.
When banks stop lending, the economy stops breathing. It's the literal definition of a credit crunch.
So if I want to start a small business or get a loan right now, I'm basically out of luck.
Unless you have a pristine balance sheet, yes. The doors are closing fast. Here is the big one. Michael Pento predicts the S&P 500 could plummet 40 to 50%.
He believes the market is pricing in a soft landing that just isn't supported by the data.
50%? My retirement account is going to look like a grocery receipt from the 90s.
It's a brutal outlook, but Michael argues that asset prices are still way too high relative to the cost of money. Finally, Michael expects us to flip from worrying about inflation to fearing a deflationary depression.
Once the credit bubble bursts, the demand for goods and services vanishes and prices collapse across the board.
Wait, lower prices sound good. Why is a deflationary depression bad for me?
Because lower prices usually come with massive unemployment. You can't enjoy the cheap prices if you don't have a paycheck. Michael's advice for Adam Taggart's audience was simple. Build up your cash and watch credit spreads like a hawk.
If credit spreads start to widen, it's a signal that the market finally realizes the risk is real.
So keep my money in the mattress and watch the news. I think I can handle that.
Maybe not the mattress, but liquidity is definitely king in Michael's playbook right now. Michael also remains bullish on gold as a way to protect against a total system reset.
When the credit market fails, people run to assets with no counterparty risk, and gold is the ultimate insurance policy.
So gold is the break glass in case of emergency button for my portfolio.
Precisely. It's the one thing that doesn't rely on a bank's promise to pay you back.
Let's kick things off with Michael Pento, who argues that we're at the end of the debt supercycle.
Exactly. Michael posits that excessive debt will eventually trigger a significant deflationary wave, leading to a market correction.
So, we're talking about a potential market crash due to too much borrowing. That sounds dire.
Yes, Michael stresses that we should prepare for shifting economic landscapes.
Next is Chris Vermeulen, who focuses on multi-asset divergence.
Chris points out that when different asset classes behave inconsistently, it signals market fragility.
Aren't we seeing that right now? Some assets are thriving while others plummet.
Exactly. And Chris believes this divergence points to increasing instability.
Then we have Jeff Snider, who tackles what he calls the employment illusion.
Jeff argues that the apparent strength in employment figures might actually be misleading.
So people are working, but they're not really part of a strong economy.
That's right. He believes the reported employment numbers mask issues beneath the surface.
Surprisingly, all three guests recognize that the market is in a delicate state.
That's a key insight. While they approach from different angles, there's consensus on potential downturn.
Wait, so they all think we might be in deep trouble soon?
Absolutely. They've all indicated we should stay on high alert. Interestingly, Chris and Jeff focus significantly on asset performance.
Right, while Chris highlights multi-asset behavior, Jeff reinforces the need to read between the lines.
So, they're both following the money, but from different perspectives.
Exactly. It's like watching a game from two different angles. Michael and Chris both underline that inflation could be a major destabilizing factor.
Yes, they agree that if inflation isn't checked, we could face severe market repercussions.
So inflation isn't just a buzzword, it's a real threat to our financial security.
You got it. It's affecting how both of these experts view future market trends. Now on to the disagreements. Michael thinks a correction is imminent, while Jeff sees it as a gradual situation.
Michael's view leans towards a swift shift, whereas Jeff predicts a slow, painful decline.
So, one says it's around the corner, and the other says not so fast. That's a big difference.
Right, and the implications for investors are huge. Interestingly, Chris suggests a potential for growth in select areas, contrasting with Pento's looming risk outlook.
Chris is much more optimistic, believing there are sectors that can thrive amid chaos.
Wait, so Chris sees hope while Michael is sounding the alarm. That's quite a contrast.
Exactly, it's the classic optimist versus pessimist debate.
Lastly, Jeff's emphasis on economic fundamentals starkly contrasts Chris's focus on market sentiment.
Jeff keeps pointing to deeper issues beneath the surface, while Chris looks at current market trajectories.
So one's watching the news, while the other's looking at stock charts.
Great way to put it. They're both important, but clearly from different lenses. If you enjoyed this analysis, don't forget to hit that like button and subscribe.
We'll keep bringing you diverse perspectives on these crucial economic issues.
Seriously, having these insights saves me a ton of time. I'm all in.
Catch us next time for more expert insights and stay informed.